Welcome to the Real Estate Investors Weekender Podcast. This podcast is brought to you by the award-winning editorial staff at NREIOnline.com. Let's jump right into this week's top news, features, and blog posts.
Welcome to the NREI Weekender with your host, David Bodamer. Let's dive into this week's top news. David, how are you?
I'm doing all right. How are you this week?
Oh, I'm doing fantastic. I know we got a lot of stories not a lot, but we got, 4 stories to cover today?
Yeah, we're going to recap 4 pieces from our site from the week.
Nice. And what are we going to start with today?
So the first piece that I want to talk about is one of our staff writers, Sebastian Obando, did a pretty big write-up based on his own reporting, combined with some of the other reporting in the financial press about what's going on with WeWork. Since they have a planned IPO, it's a company that our industry is paying a lot of attention to, since have accumulated a ton of buildings, or they've signed a lot of big leases that they are then subleasing. You know, they're kind of the co-working giant now, but they've also been like hemorrhaging cash like crazy. So they've raised a tremendous amount of capital, and they're aiming to raise even more capital through their IPO. They're also shedding a lot of this. You know, they're posting operating losses based partly because they keep acquiring stuff, or they keep signing leases at a much faster pace than they can generate any revenue. So with that being the context, there's just a lot of questions about, they've got a fairly high estimated valuation, currently about $47 billion, makes it the country's potentially the most valuable startup. You know, we've obviously had we're in an era of startups that have sort of questionable financials, but then seem to raise a lot of money. And I think that's the situation that is facing us with WeWork. So we spoke to both the people that we spoke to, and then some of the other reporting pointed to that, like, this company has only existed during what's been a bull market for both for the broad economy as well as for commercial real estate in general. So there's always been a lot of questions about what happens if we hit a recession or rents start falling. What is going to happen to them? There's also just some questions about, like, whether some of the businesses they've bought actually make any sense given what their core business is. So, I think there's a potentially a lot of both questions. There's a lot of questions that I think that we were trying to that we don't necessarily have any answers to at this point, or at least not answers to all of them. But that's what the report was trying to shine a light on, both from the broader financial press as well as the commercial real estate in particular. Okay, so let's step back for a moment. WeWork is like a shared workspace company. Is that what it is? Yeah, I mean that's how it started. That's supposed to be its core business model. You know, they're buying buildings in markets across the country, or in some cases leasing chunks of space out of office buildings. They renovate the space. They load it up with a bunch of nice amenities, like, cafe. They'll have cafes. They'll have great internet. They'll have lots of conference rooms. They'll have a lot of variety of kinds of working space, open office, variety of conference rooms, huddle rooms, all that sort of stuff. But then they also like toss in ping pong tables, and there's
a roller coaster here and there.
Yeah,
Got it.
Things to make it kind of like fun too. And the idea is that it's a place for businesses that may be up and coming, or just somebody that needs like 3 desks, or somebody that's maybe telecommuting and you just want to work in an office for a day, and that's the core of their business model.
Got it. So yeah, it sounds to me like it's supposed to be pretty flexible and all that stuff, and obviously all the amenities are nice, are a nice touch. I remember living in Seattle when Microsoft was really getting big, and I did some work out there. They had, oh my goodness, breakfast, 3 days a week at least. And they were just amazing, these spreads that they just provided for all the employees. And I mean, it was, during the tech boom where everybody was trying to get other people. And that was a big push, right? All the amenities, all the extras that you could add to these things. So it sounds like that's what they're trying to do, is set themselves apart from some of these other companies that have just been workspaces, right?
Yeah. And I think it's kind of taking that culture that feel of the startup culture that companies like Google and Microsoft had, and just creating it as a blank canvas space where this is where you can just come and work. No matter who you work for, or if you are just like a small company with like 5 people, and you don't really need to rent your own full office space yet. This a WeWork is sort of set up for you. So that's and it's certainly not a new business. I mean, that's that kind of idea of an incubator space or flexible office space has been around for a long time. But WeWork has kind of caught fire in part because of I think it's just like the brand and the image they've created and the pace of growth that they've had in terms of raising so much capital, setting up WeWorks, and you drive through every city now, and I'm always surprised to see how many it's not that you don't have to go very long before you see a WeWork sign somewhere now, because they just have they've already built such a ubiquitous presence in a fairly short amount of time. So I think that's some of the buzz around it, and why there is now this company, wants to go public. Shareholders may want to get in on it, but I mean, there's always this. To me, it's like this issue that we had, the same issue that we had in the last tech bubble, which is these companies maybe have a good core idea or they can do a certain volume of business because they're providing some kind of service, but they're not turning a profit. So at some point, isn't that an issue?
Yeah, you would think so, right? You said earlier that they're buying companies that don't exactly seem to fit their model. What kind of companies are we talking about?
Yeah, so I think this is related to specifically the owner of the company, Adam Newman. He's still the largest shareholder. He's the guy driving it. But he's also made a bunch of investments that seem to tied more to things that he's personally interested in, rather than things that seem like organically part of what WeWork, would be branching into. So things like an elementary school, a company that makes wave pools, and a natural foods business started by a pro surfer. So these are some of the other things that WeWork has now invested in, which it's hard to see exactly where the synergies might be for a flexible workspace and these other things. And so I think that's raised some flags for people.
Yeah, it seems a little odd to be purchasing an elementary school. Or you're going to set up shop there. You got people selling, tiddlywinks and toys and stuff to kids. And I don't know. It's just...
Yeah, I'm not sure maybe there is something I'm not seeing, but I'm not seeing.
Well, if MC Hammer can buy a gold toilet, I suppose this guy can buy an elementary school. I don't know.
Right.
I'm not in charge of that. Yeah. So, what else do we need to talk about with WeWork? Anything?
A couple other, I think, just some of the key numbers that were in the story is one that, they lost $2 billion in 2018. And
wow.
That was their net loss, mostly due to, just spending on these expansion efforts much more quickly than they're generating revenue. And in the first quarter of this year, they lost another $264 million. So,
jeez.
that's like the kind of some of the fundamentals underscoring what they're doing. On the flip side, what they are saying is that what might protect them from both a downturn and from any issues that emerge in the real estate market is that they have underwrite their buildings or their leases to break even if they're only 60% occupied or lower, which that's a pretty low number. Generally, their occupancy, they say right now, is between 80 and 85%. So, if that math is correct, and that is their break even point, that gives them some cushion to deal with any softness in the office market or any softness that they may have. But I think there's still just this fundamental question for me, that at some point you have to turn a profit in order to deliver return to the shareholders.
Yeah, $200 and some odd million first quarter. I get mad when I misplace my wallet. They lost $260 some odd million. It's wow. All right, what's our second story, David? Let's move on.
So changing gears. Another interesting piece we had this week looks at something that the largest warehouse and industrial owner in the world, Prologis, has been doing for the past couple of years in terms of their lease structure. This was a piece written by one of our freelancers, Beth Matson-Teague. Basically, what Prologis has been doing for the past 2 years is they debuted something called what they're calling a clear lease, which really is just meant to be a more simplified version of a lease than the traditional leases that their tenants have been signing. So it's simplified to include fixed costs related to operating expenses, capital expenses, HVAC costs, and all of those things over the term of the lease. I think part of the idea is to create a simpler lease structure for their tenants, to create a more even cost structure for the tenants, to create a more even revenue structure for themselves. So I think those are some of what is driving it. And now I think since they introduced this in the fall of 2017, they say that it's now accounts for 25% of their portfolio in North America have now been converted to these new leases. I think it's one of these things where big company, trendsetter in the market, doing something, trying something out for a couple of years. They've got decent penetration now in their portfolio with it. So, what does that mean? One of the things that it means is, it seems like they're going to continue to pursue it, try to continue to transfer other tenants over to it. And the other question always is like, when somebody does this, are their competitors going to follow suit? So far, I don't think we've seen that from any of the other industrial companies, but I think that's something that we will have to continue to keep an eye on. I think from the tenant perspective, the leases are a little shorter. So I guess they come up for renewal more often, which can be a good or bad thing. But I don't think but essentially is like just, I think, a neutral selling point at this point. And then I think another piece of this, though, that raises some interesting questions is like, if you now have different leases than the market standard, what happens if you want to sell your property? If you want to sell some of these assets to an owner that doesn't use these leases or doesn't want to use these kind of leases, that creates some issues potentially in an exit strategy when you want to divest some of your assets.
Got it. So some of the things that you had talked about earlier, before the podcast even, you had mentioned that this kind of sets the bar. So instead of operating costs fluctuating, they would set something more solid, right? So if operating costs ebb and flow for a tenant, that can be difficult to budget, right? You were talking about it's going to be better budgeting for the company itself, and then you would think it would be better budgeting for the tenant as well. But what happens if they're charging quite a bit more and the person or the tenant's not using that? You brought up HVAC system or whatever it is. What if they're not using nearly as much as what the fixed cost was set at originally? Is there going to be some sort of rebate, refund, or any of those costs?
That's a good question. I don't see any reference to that. I think that ultimately what they're trying to do is, based on the fact that they own so many properties and they have a large sample size, they know these markets, that they're trying to get the costs correct. That they want to charge what they know. If their property in New Jersey is going to have a certain level of cost based on the climate compared to one in Chicago, I think they're trying to, get those costs appropriate based on the sampling and based on their experience in operating. I don't think they are. I don't think that the idea here is to set a cost and then potentially at a higher rate than like what the usage might be.
I don't think they're trying to rip anybody off. I'm just curious of what happens if, right? I mean, they're kind of counting for a record snowfall or a lot of rain or whatever it is that's going to impact that specific business at that specific location. I could see it would be interesting. I don't have to do all the math on it to figure out these numbers. They do, but it'll be interesting to see what happens with that.
Yes, definitely.
All right, David, what else do we need to know about the story?
So I think the one last point that was made in the piece was that this may be a better fit for like larger clients, like a kind of a tenant that may be signing leases in a number of markets. They may also be helpful for the standardization. If it's just like a smaller or one-off tenant, it may not be as good a fit.
All right. Yeah, I mean, that makes a lot of sense.
The next piece that we had this week that was interesting is a look at what some retailers, apparel retailers, are doing to help boost their sagging sales numbers. So some of them are adopting a very interesting strategy in the face of falling sales. So I think the context for this is that apparel retail earnings were down 24% in the first quarter of 2019. And earnings haven't sunk this low since the Great Recession. So it was a particularly bad quarter. We also see a lot of apparel retailers are shutting stores. It's the reason that's happening is the same thing that's happening to most other kinds of retailers, which is that the brick and mortar retailers are facing increased competition from online retailers, and this is now, and it's just having a more visceral impact on sales numbers. So, a couple of interesting strategies that some retailers are adopting is basically like letting shoppers try out the apparel before committing to buying it.
What?
So,
I'm sorry. You're not talking about just trying it on.
Just trying it on. So, like Lululemon at their flagship store, I think in Chicago, is allowing customers to take a workout class in the gear that they're considering buying before they commit to it. So,
what?
They basically just get an outfit, take a yoga class, decide if they still want it.
Okay, so they're going to loan somebody yoga pants or yoga clothes to go get all hot and sweaty in the clothes and then bring them back for somebody else to buy.
Yeah, I think they.
I got a problem with this. I got a real problem. I got boundary issues with this. I'm just saying.
The class is in the store, so I think it's like I don't think you're necessarily taking it home. I think it's like you have to try it out in the store, take a class there. That's my understanding.
Brother, I can sweat in a store or at my house the same. I mean, I'm still sweating in that outfit, and then I'm just going to put it back on the rack. I mean, they may even launder it, but doggone it. Doesn't that seem a little odd to you?
It seems a little odd. I think it's speaking to how much that that they feel the need to do something to help drive their sales. And I think they're also responding to a general try before you buy culture that's emerging. There are groups. There's Warby Parker, allows you to, the online glasses retailer where you order 5 pairs and they send you 5 pairs, you try, or 5 frames, you try them all on, and then you keep the one that you want to keep and send the others back. But basically you get a chance to try 5 pairs before you commit to anything. There are also, because there's competition from things like, there are now like services like Rent the Runway, where apps where you can basically rent clothes that way. Now there are pressures that are now basically shaping the brick and mortar apparel business.
Yeah, I get that. I've rented tuxedos. I used to represent tuxedo rentals for a store. But there's a difference between tuxedos and yoga pants.
Yeah.
I'm just saying. Yeah. I mean, we'll see where it goes. But
they're trying it in their flagship, and they say that depending on how this works, they could roll it out to up to 10% of their stores.
Yeah, that would be interesting to see how that 10% does and what the market thinks about that. And maybe I'm just archaic. Maybe I'm just too old to think that far forward. But even from their website, it says they make technical athletic clothes for yoga, running, working out, and most other sweaty pursuits. That's right on the website. You're talking about sweaty pursuits. Okay.
So a different retailer, which maybe will be a little bit not seem quite as intense.
Okay. Yeah.
H&M is also doing something where basically a buy now, pay later program to help persuade customers to try to spend more. So now you can basically buy an item at H&M, keep it for up to 30 days before deciding if you want to keep it. And you can then choose to split your payments. You could either just choose to pay at that point or split your payment into 4 interest-free installments spread over 2 months.
Got it. Okay.
And I guess Urban Outfitters and Abercrombie and Fitch also have programs like this now too.
Yeah, you said Abercrombie and Fitch does too?
Yeah.
Don't they sell a lot of underwear? I'm just saying. Are there rules to this, David? Because I don't want somebody wearing drawers for 30 days and then it going back to this. Anyway, okay. Is there anything else, man? I mean, I don't want to beat that horse to death, but yeah, okay, that one just creeped me out. You got another story for us?
So our last piece for the week is just an update on, it's an update on what Fannie Mae and Freddie Mac, the 2 largest agency lenders, are doing. And they've been doing this sort of interesting thing, which is, since they are managed by the FHFA, which sets specific lending limits for how much business these 2 GSEs are supposed to do. They normally have like a certain cap of how much lending that they do every year. Somewhat, it's regulated. It's set federally, but there's a loophole which they increasingly have been using to then extend to do more business, which is that there are certain loans that qualify that don't count towards their lending limits, that they can, lend to a property. And specifically, this has to do with doing loans on affordable housing or energy efficient properties. So any loans that they do on properties that qualify, normally you have to qualify your building as affordable housing or energy efficient in some way. Then you can get this. Then if you do that, then since those are, considered things that we want to encourage, then, okay, those don't count towards Freddie and Fannie's caps of $35 billion. They're supposed to do about $35 billion a year. But in practice now, what's happened is they're pushing more and more borrowers, or encouraging more and more borrowers to qualify for these kind of programs, so that they can just do just do additional volume in these programs that doesn't count against their caps. So in 2018, Freddie Mac made $77.5 billion in loans, and Fannie did $64.4 billion. That's basically because more than half of their loans are now being done in these programs that don't count against their caps.
I've got my cynic hat on, man.
Yeah.
Didn't we learn something from this like 10 years ago?
Well, I think the difference is that these are not necessarily subprime.
Well, I know, but you're talking, the word loophole, when you say it with these 2 names, that bothers me.
I think the issue rather than maybe that they're doing, there's no indication that they are being too aggressive about their underwriting or lending to shady properties or to unqualified borrowers. I think what the real issue is that these enterprises are just then become to dominate the market, or become very hard for other kinds of lenders to compete against if they're trying to lend to the same kinds of properties.
Gotcha.
So I think it's if anything, it's maybe a competitive issue that the in spirit they're vitally maybe going beyond the spirit of what they're supposed to be doing by being very liberal about the kinds of properties that are fitting into their exceptions in order to increase their volume of business. And what does that mean for that? Then what does that do for the rest of the market? Because JP Morgan or Wells Fargo, or whoever else who's trying to lend on multifamily family properties is competing against these agencies who now are just the biggest players in the market.
Well, maybe competition is good for the consumer, right? Maybe we can end on a positive note. Maybe that's what we take away from this. Yeah.
as long as we're not in the situations like we were in 10 years ago, where we are doing too much interest only, or, too high loan to value ratios, or underwriting properties with far too aggressive assumptions about rental growth or asset value growth. Those are, to me, are like the big red flags that we would have to look out for the capital markets. If it's just an issue that maybe Fannie and Freddie are taking too big a share and they're making it more difficult for other banks, I mean, that's an issue, but it's not it's not the same kind of systemic risk that we were talking about the last time around, when everything that was kind of covered in the Big Short was what came and blew up the single housing market, and similar dynamics were affecting the commercial real estate market.
Got it. Okay. This was a great recap. Anything else to close on?
That is, those are the highlights for this week. I mean, we had some other stories on our site, so just make sure to go to NREIonline.com for some other pieces that we posted, and stay tuned for our podcast next week.
Sounds good, David. Thank you so much. All right, and thank you all for listening to the NREI Weekender with your host, David Bodamer. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when David comes out with a new podcast, it'll show up directly on your listening device. Again, thanks for listening today. For everyone at the NREI Weekender, this is Aric Johnson inviting you back next week for all the news that matters to you. And we'll see you soon.
Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of NREI Informa. The content has been made available for informational and educational purposes only.